30%. If you just look at the percentage, it looks like a typo. You stare at the screen, refresh the feed, and assume the data provider is glitching. Silver doesn't move 30% in 2 sessions. Maybe a crypto shitcoin does, maybe a bankrupt tech stock does, but not a tier 1 monetary asset. Not when the world is supposedly on fire. It's Monday evening, February 2nd. The markets have just closed and the silence is deafening. I've been sitting here for the last 4 hours watching the aftermarket ticks, trying to make the math work, and it just doesn't. If you've been following this, you know the headline. Friday afternoon, January 30th, the White House drops the bomb. Kevin Warsh, the nomination for the next Fed chair. The one guy the market was absolutely convinced wouldn't get the seat because he's too hawkish, too focused on sound money, too critical of the last 15 years of easy liquidity. And the reaction was violent. We saw silver fall from near 120, levels we thought were the new floor, to under $80 in 48 trading hours. Gold is down nearly 10%, shedding almost $600 an ounce. It's the kind of move that wipes out accounts. I'm seeing reports of liquidations that make 2020 look orderly. But here's the problem. Here's why I'm recording this right now instead of stepping away. The narrative is already setting in. You turn on the financial news and they're telling you a simple story. Hard money man nominated, inflation expectations drop, metals crash. It's neat, it's logical, it fits in a tweet. It's also wrong. Or at least it's dangerously incomplete. Because if you actually look at the bond market, if you look at the 10-year yield, if you look at the spread between the 2-year and the 10-year, they didn't move enough to justify a 30% collapse in silver. The math doesn't line up. If this was just about Warsh and real yields, we should have seen a 5, maybe 8% correction. Painful, sure, but not a crash, not a meltdown. Something else broke on Friday. I was looking at the tick-by-tick data from the CME when the news hit. The selling didn't start with the announcement. It started seconds before. And the volume wasn't human. It wasn't fund managers reallocating portfolios. It was forced. It was mechanical. And then I saw a specific notification from the clearinghouses regarding margin requirements that went out this morning, effective immediately. That's the piece that scares me, because when you see a margin hike of that magnitude right in the middle of a crash, it tells you that the exchanges are worried about solvency. They aren't trying to cool the market down. They're trying to prevent a systemic failure of the counterparties. So forget the politics for a second. Forget whether you like Warsh or hate him. What we are watching isn't the policy pivot. It's a liquidation event. It's a margin call on the entire debasement trade that everyone has been crowded into for 2 years. And usually when you get a liquidation cascade like this, the first drop is just the warning shot. I need to show you exactly where the leverage is hiding, because a lot of people think they bought the dip this morning, and I think they might have just stepped in front of a freight train. Let's look at the plumbing. This wasn't just a bad trade. This was a structural failure of the consensus view. And if you're holding positions right now, you need to understand exactly who is selling, because it's probably not who you think it is. The plumbing of this market has been rotting for months. We all saw it, even if we didn't want to admit it. Since late 2024, the entire financial complex, hedge funds, retail traders, pension allocators, had crowded into one specific bet, the debasement trade. The thesis was simple. Debt is too high, the deficit is unmanageable, so the Fed has no choice but to print. It doesn't matter who is in charge, they have to monetize the debt. That was the gospel. You bought gold, you bought silver, you shorted the dollar, and you went to sleep. It worked. It worked so well that people stopped checking the risks. They stopped looking at the cost of leverage. And that is where the trap was set. When the Warsh announcement hit the wires on Friday afternoon, the algorithm didn't just read hawk, it read regime change. But here's the contradiction I mentioned a moment ago, the thing that doesn't fit the clean little news stories you're reading. If this was purely a repricing based on interest rates, we can do the math on that. We know the correlation. Historically, for every 10 basis points real yields rise, gold might shed 1 or 2%. On Friday, real yields, that's the return you get on bonds after inflation, ticked up. They moved maybe 15, 20 basis points. Significant, yes, But did they move enough to justify silver losing a third of its value in 48 hours? Did they move enough to knock gold down 16%? Absolutely not. The math is broken. You don't get a 30% candle on a policy tweak. You get a 30% candle when someone is forced to sell asset A to pay for debt B. This is a liquidity event, not a valuation event. The distinction matters because valuation events take months. Liquidity events take days, and they are indiscriminate. They don't care about your fundamentals. They don't care that silver is needed for solar panels or that central banks are buying gold. When a margin clerk makes a call, they don't ask for your thesis. They hit the sell button until the account equity is positive. Look at the timestamp on the biggest red candles. They didn't happen during New York banking hours. The most violent moves, specifically that drop in silver below $90, happened in the Asian session overlap, Shanghai and London. That tells us where the leverage was hiding. It wasn't just the retail guys on Robinhood. It was likely massive, leveraged structured products in the East that were using silver as collateral for other loans. When silver cracked $100, a psychological fortress, those collateral agreements triggered. Boom. Forced selling. That selling drives the price to 90. At 90, the next tier of leverage blows up. It's a feedback loop. And here is the scary part, the part that makes me sit up straight. The CME Group, the exchange that manages these futures contracts, didn't wait for the dust to settle. They raised margin requirements effective this morning. Think about the psychology of that. You are a trader, you're already down 20% on your position, you're bleeding. And then the exchange emails you and says, to keep this losing position open, you need to wire us more cash by 5 p.m. What do? You don't wire the cash, you don't have it. You sell, you capitulate. That is why we're seeing this relentless drift lower after the initial shock. It's the sound of thousands of positions being involuntarily closed. This exposes a specific group of people, and if you are in this group, you are in the danger zone right now. I'm talking about the late cycle buyers, the people who bought silver at 110 or gold at 5,500 because they saw the momentum. These buyers have no equity buffer. They are underwater. They are panic checking their balances every 10 minutes. They are the fuel for the fire. Conversely, the people who are protected, the only people who are sleeping tonight, are the ones who aren't using leverage, the physical holders, the unlevered funds. They are looking at a screen of red, sure, and it hurts, but they aren't receiving a phone call demand for capital. They have the luxury of time. The levered player does not. But this isn't just about leverage. There's a deeper signal here that almost everyone is misreading. The media is telling you that the market is crashing because it fears Kevin Warsh will tighten conditions. They're saying the market is afraid of tight money. I suspect the opposite is true. I suspect the market isn't crashing because it fears Warsh will succeed. It's crashing because the smart money knows that if he tries to tighten, if he actually tries to normalize the balance sheet and stop the printing, something much bigger than gold is going to break. The bond market is the elephant in the room. If Warsh pushes real yields up to 3 or 4% to kill inflation, the US government cannot afford its interest payments. So why sell gold? Why sell the insurance against that exact scenario? This is where most people get trapped. In a liquidity crisis, you sell what is liquid. You sell what has a bid. You don't sell the illiquid corporate bonds that haven't traded in weeks. You sell gold because you can. You sell silver because it's a standard contract. During the crash of 2008, gold fell nearly 30% initially. Why? Because hedge funds needed cash to cover their losses in subprime mortgages. We are seeing a replay. The Warsh announcement pricked the bubble, but I don't think the bubble was gold. I think the bubble was the everything rally. And now that liquidity is being withdrawn, or at least the threat of withdrawal is real, asset classes are correlating to one. Everything is going down together. But there is a specific mechanism at play right now, buried in the open interest data that suggests we aren't at the bottom yet. I saw a number this morning regarding the short interest in the miners, the companies that actually dig this stuff out of the ground, and it doesn't match the price action of the metal. Usually, miners lead the metal. If the metal is going to bounce, the miners start moving up first. Today, the miners were down more than the metal. GDX, the big gold miners ETF, was down almost 12%. That is a capitulation signal. It means the equity investors, the guys who look at cash flows and balance sheets, are throwing in the towel. They aren't buying the dip, they are fleeing the sector. Now, you might look at this and say, okay, so I sell everything and wait. That feels safe, that feels prudent. But here's the risk you take if you walk away now. Liquidity events are V-shaped. They crash hard, they flush the leverage, and then, the moment the selling pressure exhausts, they rip your face off to the upside. If you sell here, at the point of maximum pain, you are effectively transferring your wealth to the person who has the cash to absorb your panic. The question you have to answer, and we are going to get into the specific mechanics of this next, is whether this is a solvency crisis or just a leverage flush. If it's just leverage, we are near the end. If it's solvency, if a major fund or a bank is on the wrong side of this Warsh trade, then $80 silver is going to look expensive. And there is one chart, one specific ratio between the banks and the metals that is flashing a warning sign I haven't seen since March 2020. It suggests that the banks are not just facilitating the sell-off, they are actively de-risking their own books. In a minute, you'll see why that distinction changes everything about how you trade tomorrow morning. Because if the banks are running for the exit, the floor isn't where the technical analysts say it is. The floor is wherever the Fed decides to step back in. And with Warshing coming, they might not step in at all. You need to understand the mechanics of why the banks are de-risking, because it's not emotional, it's mathematical. And it centers on one specific concept that almost no retail trader pays attention to until it's too late. It's called a collateral haircut. It sounds technical, it's actually very brutal. Here's how the machine works. When a big fund wants to borrow money to trade, they don't just ask for cash, they pledge assets, treasuries, corporate bonds, and yes, sometimes gold and silver as collateral. The bank looks at that gold and says, okay, this is worth $5,000, we'll lend you $4,500 against it. That gap, that's the haircut. But here's the catch. The size of that haircut isn't fixed, it's dynamic, it's based on volatility. When the price of gold is steady, the bank feels safe lending against it. But when gold drops 9% in a day, when silver crashes 30%, the bank's risk model screams red. Suddenly, that collateral is viewed as toxic. So the bank doesn't just say, pay us back, they say we are changing the terms. Yesterday, they lent you 90% of the value. Today, because volatility spiked, they might only lend you 70%. Do the math on that. You didn't just lose money on the price drop. You lost your borrowing power. You have a hole in your balance sheet that just got 20% bigger, instantly, without a single trade happening. This forces you to sell the asset to raise cash to cover the difference, which drops the price further, which spikes volatility further, which increases the haircut again. This is the death spiral. This is why the chart looks like a waterfall. It's not sentiment, it's a feedback loop of collateral destruction. And what people are missing, what the guys drawing trend lines on Twitter are completely ignoring, is that this isn't isolated to metals. I'm watching the bond market volatility index, the MOVE index. Think of it as the fear gauge for treasuries. Everyone watches the VIX for stocks, but the VIX doesn't matter right now. The MOVE index is the heartbeat of the global financial system. Since the Warsh announcement, the MOVE index has spiked. Why does that matter? Because the entire financial world uses US treasuries as the ultimate safe collateral. If the bond market is volatile, if the safe asset is jumping around like a penny stock because traders are terrified of what Kevin Warsh will do to the yield curve, then nothing is safe collateral. When the foundation shakes, the penthouse collapses. Silver is the penthouse. It's the furthest out on the risk curve. That's why it fell 30%. It's the highest beta asset in a world that suddenly hates beta. So the signal I'm watching isn't the price of silver, it's the stability of the bond market. Until the MOVE index calms down, until the bond market believes that Warsh isn't going to blow up the system, there is no floor for metals. However, I want to stop here. I want to be intellectually honest with you because it is very easy to get caught up in the bearish momentum and sound like a doomsday prophet. There is a scenario where this entire thesis is wrong, and you need to hear it. If I am overestimating the market's fear of Warsh, if this is truly just a sell the news event, a temporary flush of weak hands, then what we are seeing right now is the buying opportunity of the decade. The counter-argument goes like this. The debt is still $36 trillion. The interest payments are still over $1 trillion a year. Kevin Warsh is a smart guy. He knows he cannot actually normalize rates without bankrupting the U.S. Treasury. He talks a big game about hard money, but when he gets in the chair, the math will force him to print just like Powell, just like Yellen, just like Bernanke. If that is true, if the Warsh shock is just rhetoric, then the fundamentals for gold and silver haven't changed one bit. In fact, they've improved because now you can buy them at a 30% discount. If the Fed is trapped, regardless of who the chair is, then this dip gets bought aggressively by the sovereigns, by China, by India, by the central banks who don't care about daily volatility. If we see a massive reversal candle tomorrow, if silver reclaims 90 and holds it, that validates the Fed is trapped thesis. It means the market called Warsh's bluff within 48 hours. So we are standing at a binary point. We are looking at two very different futures, and they diverge right here, this week. Path 1, the Volcker 2.0 scenario. Warsh is serious. He is willing to induce a recession and a market crash to kill inflation expectations. In this world, the liquidity drain continues. The haircuts get worse. Silver goes to 50, gold goes to 4,000. The deflationary bust is real, and cash is the only king. Path 2, the paper tiger scenario. The market realizes Warsh is handcuffed by the debt. The bond market stabilizes because traders realize he can't tighten. The liquidity comes back, and this sell-off becomes a bear trap that shakes out the leverage before the next leg up to new highs. How do we know which path we're on? We don't guess. We watch the reaction to the next support level, because there's a specific price zone coming up, a zone that is held for 3 years that is about to be tested. If it breaks, the game changes. If it holds, the bluff is called. Let me tell you exactly what that level is and what I'm doing if we hit it. When you look at the technical damage, there's a number that stands out, and it's not a price, it's a ratio, specifically the gold to silver ratio. In the last 48 hours, that ratio hasn't just moved, it's snapped. Silver's 30+% collapse relative to gold's 10% correction is a historical anomaly that usually signals one of two things. Either silver was a massive bubble that finally popped, or we are witnessing a temporary liquidity trap where the more volatile asset is sold first to cover the most urgent debts. If you're looking for the floor, you have to look at the $70 mark for silver. That is the level where the 200-day moving average sits, and more importantly, it's where the massive open interest from the commercial banks began to build late last year. If $70 breaks, we aren't just in a correction. We are in a regime change where silver returns to being a boring industrial metal rather than a monetary hedge. But what actually moves outcomes from here isn't the price of the metal itself, it's the dollar index, the DXY. Since the Warsh news, the dollar has been on a tear pushing back towards that 97 level. In a world where every major currency is racing to the bottom, the dollar is the only hard thing left for institutions to hide in when they are scared. If Warsh represents a return to dollar strength, then the precious metals trade, the debasement trade, is effectively dead for this cycle. However, here is the structural signal that most people are ignoring. Look at the central bank gold buying data. While the paper markets in London and New York were melting down on Monday morning, reported physical premiums in Shanghai and Singapore actually rose. The paper price was crashing, but the cost to get physical metal in your hands was increasing. That is a massive divergence. It tells me that while the Western leveraged funds are puking their positions to meet margin calls, the Eastern sovereigns are using this war shock as a gift. They're absorbing the liquidations. So here is the binary setup we are facing as we head into the next few trading days. Path A is a capitulation floor. We see silver hold that $70 to $75 range. We see the volume dry up. We see the RSI, the momentum gauge, hit levels of oversold that we haven't seen in a decade. If that happens, the flush is over. The leverage is gone. The market has been cleaned, and the next move is a slow, grinding recovery back to the highs. Path B is the systemic unwind. This is the darker road.
This is where $70 fails and the selling moves from the speculative traders to the long-term holders. This is where people start questioning the very idea of gold and silver as a hedge because the Fed is finally serious. If that happens, we are looking at a multi-year bear market. What I am watching to differentiate between these two isn't the news, it's the long tail. If you look at the daily candles for today, February 2nd, both gold and silver left long tails on the bottom of the charts. That means that every time the price dipped to those extreme lows, someone with very deep pockets stepped in and bought. The vulture capital is starting to circle. I'm not a buyer yet. I'm not a seller yet. I'm an observer. Because in a week where $15 trillion of wealth just evaporated, the only way to stay solvent is to wait for the market to tell you which path it has chosen. We are entering the phase where the noise stops and the architecture of the next decade reveals itself. When a market moves this fast, it's no longer about investing. It's about survival and positioning. Here's how the scenario tree looks from my desk. If the dollar index, the DXY, closes the week above 104 and holds it, we have to accept that the war shock has fundamentally altered the liquidity environment. In that scenario, the consequence is a prolonged period of real yield dominance. Gold and silver will likely drift lower as the market prices in a Fed that is willing to let the economy run cold to protect the currency's purchasing power. If that happens, my playbook is simple. I am not catching falling knives. I am watching for the moment the Treasury market begins to revolt against these higher rates, because that is when the Fed will be forced to pivot again, regardless of who's in the chair. If, however, we see a failure to follow through, if silver holds 70 and the dollar starts to give back these gains by Friday, then we have witnessed the mother of all bear traps. This would suggest that the market has looked at Warsh, looked at the $36 trillion in debt, and decided that the hard money narrative is a bluff that the math simply cannot support. If the bounce is sharp and high volume, it confirms that the structural demand for hard assets is stronger than the temporary fear of a hawkish Fed. I am watching three things with extreme focus right now. First, the physical bullion versus paper futures. If that spread continues to widen, it tells me the crash is an optical illusion created by levered paper exits, while the real-world value remains intact. Second, I am watching the credit default swaps on major sovereign debt. If those spike while metals fall, the divergence is unsustainable. Something will have to give. Third, I am listening for any backtracking or clarification from the transition team regarding the Fed's independence or its mandate. One sentence about market stability could spark a $200 rally in gold in a single afternoon. What I am explicitly not doing is panic selling into a liquidity vacuum. I've seen this movie in 2008 and 2020. The most expensive mistakes are made when you let the margin clerk dictate your long-term thesis. So I'll leave you with a question to consider tonight. Do you believe a single man, no matter how hawkish, can reverse 40 years of debt expansion without breaking the global financial system? I'd be interested to hear your reasoning on that, especially if you think I'm missing a piece of the regulatory puzzle that gives Warsh more room to maneuver than I'm seeing. Next time, I want to dig into a specific internal Fed document from 2011, one that Warsh himself had a hand in, that outlines exactly what he thinks should happen to the Fed's balance sheet during a crisis. It's the closest thing we have to a roadmap for the next 4 years.